As many of you know, Zhang and I aren't financial advisors. We actively invest, and our plan is to talk in detail about investments we and our friends find interesting. 2 weeks ago, we spoke with a friend about building his $5 million college real estate portfolio. This week, we'll talk about an investment we made in a music school roll-up. A roll-up is a common investment strategy where you buy a lot of smaller businesses, combine them, and then sell the larger combined business. Done well, a roll-up can be a high return investment. In this case, our original investment of $70,000 grew to $420,000 in 3 years, a 6x return on investment. We hope this is a new and interesting strategy for listeners. Let's jump in.
A few years ago, Nick and I invested in a music school business. The idea was that someone was going around buying these small music schools and then combining them into a bigger entity in the concept called a roll-up. These music schools are very small in scale. Typically, they had a few employees and were generating about between $100,000 and $300,000 annually in cash flow. Because these businesses are so small, you could actually go out and buy them at between 2 and 3 times cash flow. So for example, if a business was generating $100,000 of cash flow per year, you could actually pay $300,000 and purchase that business in its entirety. The idea behind this strategy was the owner would go around buying these small businesses in different geographies, combine it into a bigger business, and then sell it at a higher multiple or valuation.
That makes a lot of sense. And maybe to give a bit of context for the audience, what was the size of the investment for us? How should we think about what the returns were as well?
So Nick and I were introduced to the owner of this business through a friend. And because we didn't know him directly, and because it was a small business, we wanted to make sure that we weren't investing a huge portion of our net worth into this. Collectively, Nick and I put in around $70,000 at the end of 2019. And towards the end of 2022, we effectively made 6x on our money. So ultimately, our stake was worth at about $420,000 when we exited the investment.
This was probably one of the higher returning investments in our portfolio. What were the largest drivers of that return?
Yeah, obviously it was a very happy day when Nick and I found out about the result of this. So one important thing with these roll-up strategies is you want to acquire small businesses and then get to a certain scale where you can sell to someone who is willing to pay a higher multiple. So I mentioned earlier that the owner and operator was going out and buying these businesses at 2 to 3 times cash flow. Once you get to a certain scale, these are, at the end of the day, good businesses, right? So inherently, they should not be trading at 2 to 3 times. It just so happens that in this market, it's very inefficient, and we were the only buyers out of the market. So we were able to buy these businesses at a low multiple. Once you get to a certain scale, you're able to sell that at a much higher multiple. So we ended up exiting the business at around a 9 times multiple. So part of it is we grew the business organically. And then the second part is this multiple arbitrage that really allowed us to juice our returns. And ultimately, if you're investing in a roll-up of small businesses, this is the kind of outcome that you're looking for.
One theme that has come up a couple times already is when you invest, you want to protect your downside and the upside will take care of itself. Do you mind talking a bit about how we try to decrease the risk of this investment?
Sure. So I'll start out on the downside protection first. The first and most important thing is alignment of incentives. You don't want to be giving someone money if they're putting in no money of their own, right? So one of the first questions that we ask in any diligence process is how much money are you putting alongside the business? So we felt comfortable because the owner of the business was putting in a substantial percentage of his liquid net worth into this. So we felt confident that if the business wasn't going to succeed, then he would feel the pain as well. So that was point number one. Point number two was that we structured it in the form of a preferred. What does that mean? That means that we basically get liquidation preference. So if the business were sold, we as investors would get payback first before the rest of the value accrues to the equity holder. In this case, the owner of the business. And then finally, we obviously want to participate in the upside, right? It's not super interesting to be invested in this just to earn 8 to 10% return. So one thing that we want to make sure about is if the business were sold for a high multiple, that we would share in the upside. And ultimately, that's what happened.
For listeners who are less experienced with preferred structures, do you mind explaining that in a bit more detail?
Yeah, absolutely. So preferred shares are effectively a hybrid between debt-like instruments and equity-like instruments. So it's debt-like because there's a preferred rate of return that you as an investor would earn before the equity investor is able to make money. So in this case, our preferred rate of return was 8%, which meant that we, as holders of the preferred equity, would earn 8% return before the manager or the owner even makes a single dollar. The second piece of it is you share in the upside. So if the business is ever sold or if there's a change of control, you would get paid out like the equity, except that you would accrue interest on the way.
So after this investment, what do you think in general of this strategy of buying and rolling up smaller businesses?
Yeah, I think, again, this strategy is not new, right? The strategy has been around for a long time. I've had many friends invest in different roll-ups. I think one of the earliest ones was roll-up of car washes, and then there's all these roll-up of small service businesses that end up working. I would say unique to this opportunity are really two trends. I think number one is as baby boomers start retiring, a lot of them don't want to continue operating businesses, right? So you want to look for industries and markets where there's a significant percent of owners who are baby boomers who are trying to exit. And in that situation, there'll be forced sellers, so you can get a very attractive price by going after those businesses. I think the second important point is to just keep an eye on demographic trends, right? Spending on education is something that's paramount to pretty much every family, and it cuts across cultures. And in the case of music schools, again, even during COVID and even during, I'm sure, recessions, parents are still willing to spend on education, and that spend is very inelastic. So I would say look at what the demographic trends are telling you, look at areas where there's opportunity, regardless of how the economy is, and that's where you're going to get comfortable investing in these types of businesses.
What are some of the important lessons you feel like you've learned from this investment?
Yeah, that's a good question. I would say the first lesson that I learned was that a lot of the times unique investment opportunities exist because bigger institutions are not looking at these opportunities. So in this scenario, these businesses are way too small for larger funds, whether it's private equity funds or family offices, to be even exploring this. So we're effectively the only buyers out of the market, and that's the way we're able to get 2 to 3 times cash flow on a lot of these deals. And that was part of what we believed in when we underwrote the investment. I think the second thing is the importance of getting access to proprietary deals. We got introduced to this deal through a friend, and it wasn't like an open process where we're bidding against all of these people who are trying to invest. As a result, we were able to get very favorable terms. And I think that applies to a lot of private equity processes too, right? A lot of the times private equity firms emphasize the importance of having a proprietary pipeline just so that you're able to get a better price and therefore a better return. So I would say those two are probably the most important lessons.
Perfect. Thanks, John, for spending some time and giving us an overview of this investment.
Yeah, of course, anytime. And obviously, Nick, we invested in the music school together. So any important learnings from your side?
Yeah, I think from my side, the biggest learning was when you have the right person in place building the business, someone who's able to adapt to changing circumstances, in this case, COVID, which was a very, very big change, and able to persevere through those moments. And you set up the right incentive structure for them to succeed, where in this case, because his life savings were invested in the business and he only makes money after we make our 8%, that type of incentive structure really creates momentum for the business for him to achieve a result like 6x the original investment. So having a pretty resourceful person plus the right incentive structure creates an environment that drives someone towards a good outcome for everyone.
Awesome.
Thanks for listening in. I'm Nick, and I've worked in finance for almost a decade. If you enjoyed this video, please give it a like and follow our channel for future videos. You can check out our WeChat group for more wealth and retirement tips. Talk to you next time. Bye.